As of the close of the last trading session on Friday, November 2025, Applied Digital Corp, ticker symbol APLD, finished at $21.09, $21.09 with after-hours action pushing slightly higher to $21.28, $21.28. If you are watching this on a Monday morning or placing orders through your Fidelity mobile app, you are looking at a stock that has seen a massive intraday swing, trading in a range between roughly $19 and $21.50. The volatility here is palpable, the kind that makes Robinhood stock trading forums light up with speculation. But if you are just looking at the price action, you are missing the entire story. This brings us immediately to the tension between expectation and reality, the single most important dynamic in the market right now. The expectation, the lazy narrative you will hear if you just skim headlines or browse SoFi Invest discussion boards, is that Applied Digital is just another Bitcoin miner trying to rebrand itself to catch the AI hype wave. The market expects a company tethered to the price of crypto, suffering from the same headwinds as other miners who are struggling with halving cycles and energy costs. That is the expectation, a speculative, low-quality crypto proxy. The reality, however, is shattering that assumption in real time. Applied Digital is not pivoting. It has effectively become a critical infrastructure backbone for the high-performance computing (HPC) market, specifically tailored for the massive, power-hungry needs of generative AI. While investors are busy arguing over Tesla stock or wondering if Nvidia stock has peaked, APLD has been quietly securing billions, yes, billions with a B, in financing to build the physical factories where AI actually lives. The company just closed a $2.35 billion private offering and secured nearly 800 more from Macquarie Asset Management. You do not get that kind of capital from institutional giants if you're just another crypto miner. You get that when you're building the railroads for the next industrial age. Let's back up and look at the common ground. Most of you probably found APLD while screening for high-beta tech stocks on Interactive Brokers or looking for crypto-adjacent plays. It is natural to group them with the likes of Marathon or Riot because historically that's where they came from. The company builds and operates next-generation data centers. In the past, these centers were filled with ASIC miners hashing away for Bitcoin. It was a simple business: cheap power in, crypto out. This history is why the stock trades with such violent volatility. It is still shedding its old skin in the eyes of the algorithm-driven trading bots that dominate Schwab Intelligent Portfolios and other investing sites. But here's the challenge to that belief. The Ellendale project in North Dakota. This is not a mining farm. It's a 400-megawatt HPC campus designed for liquid-cooled, high-density computing. Why does that matter? Because the H100 and Blackwell chips from NVIDIA that everyone is obsessed with can't run in a standard air-cooled warehouse. They run too hot. They need specialized infrastructure. Applied Digital is one of the few companies that has the power access, a rare commodity, and the technical design to host these chips at scale. When you log in to your Fidelity brokerage account and see APLD moving, it's not because Bitcoin went up, it's because the market is waking up to the fact that power availability is the new gold. Let's break down the recent price action and volume because it tells a fascinating story of institutional accumulation. Over the last month, we've seen average daily volume spike well above 30 million shares. This is not retail traders on Robinhood crypto flipping pennies. This is institutional turnover. When you see a stock holding the $20 level despite a massive issuance of debt, it signals that the market views the debt not as a burden, but as growth fuel. The $2.35 billion note offering is effectively a war chest. They're using this cash to fund the build-out of their Ellendale 02 and Ellendale 03 buildings. If you use interactive broker stock trading tools to analyze the order flow, you'll see large block purchases occurring on dips. This suggests that smart money is looking past the current negative earnings per share, which sits at a staggering negative $1.13, and focusing entirely on the contracted revenue backlog. The company has mentioned billions in long-term contracts. This is the difference between a transactional business, selling crypto, and a utility-like business, renting massive server space to a hyperscaler. Speaking of hyperscalers, let's talk about the elephant in the room. Who is the customer? Applied Digital has been cryptic, often referring to a major hyperscaler in their press releases. The rumor mill, which you can find in any online investing community or SoFi active investing chat, often points to companies like Microsoft or a similar giant that needs capacity now. The big tech companies have the chips, but they don't have the buildings or the power ready fast enough. APLD does. This creates a supply-demand imbalance that favors the landlord, which in this case is Applied Digital. I want you to pause for a second and think about your own portfolio. Comment below how many shares of APLD you currently hold, or if you are waiting for a pullback to $18 range. Are you playing this for the short squeeze potential, or are you holding for the 2026 infrastructure boom? Let me know in the comments. Now, we need to address the financials because they're the scary part of the reality. If you look at the fundamental data on your Fidelity Wealth Management dashboard or SoFi Robo-Advisor report, APLD looks terrible. They're burning cash. They have high debt. Their net profit margin is deeply negative. If you were a traditional value investor using Schwab Intelligent Portfolios to filter for safety, this stock would be filtered out immediately. But this is where the infrastructure play thesis comes in. Real estate and utility development is always capital intensive. You spend billions up front to build the dam, and then you sell the electricity for 50 years. APLD is in the building the dam phase. The expectation is that they'll run out of money. The reality, confirmed by the Macquarie deal, is that capital markets are lining up to give them money because the projected returns on AI hosting are so high. Let's look at the broader sector momentum. You can't analyze APLD without looking at NVIDIA stock and the broader semiconductor equipment space. When NVIDIA reports earnings and says demand is insatiable, stocks like APLD bid up. Why? Because every chip NVIDIA sells has to go somewhere. It has to be plugged into a rack, in a building, with power and cooling. APLD is the glove to NVIDIA's hand. If you are bullish on Apple stock integrating AI or Tesla stock solving full self-driving, you're implicitly bullish on the data centers that train those models. APLD is a leveraged bet on that physical constraint. However, we must remain objective. The risks are real. The Polaris Forge 2 project and the Ellendale expansion are massive construction projects. Construction has risks, delays, supply chain issues, regulatory hurdles in North Dakota. If they miss their timelines, those contracted revenues get pushed out, and the cash burn could become a solvency issue. This is why you see the short interest remaining relatively high. Short sellers are betting that the execution risk is too high. If you are using interactive brokers or Fidelity IRAs to hedge, you might be looking at put options as insurance. But if they execute, the upside repricing could be violent. The company also has a cloud service division, essentially renting out GPUs directly. This puts them in competition with CoreWeave and Lambda Labs. While this is a high-margin business, it's also operationally complex. Management has hinted at potentially spinning this off or separating it to become a pure-play infrastructure REIT. That is a massive catalyst, likely forcing a re-rating of the stock, similar to how Fidelity ETFs that track digital real estate are valued at much higher multiples than crypto miners. For those of you engaging in self-investing or looking for investment help, you have to understand the specific instrument you are trading here. APLD is not a set-it-and-forget-it stock like a boring index fund you might find on investing sites. It is a high-beta, high-variance play. The daily range can be 10%. If you are using Robinhood fractional shares to dollar-cost average, that might smooth out the volatility, but you need to be prepared for days when the stock drops 15% on no news simply because Bitcoin dropped and the algorithms haven't figured out the decoupling yet. Let's look deeper into the Macquarie Asset Management deal. This is a preferred equity financing facility. In plain English, it means a massive institutional investor looked at APLD's books, looked at their contracts, and said, "We will